everybody, it is your favorite podcast. Drum roll, the Brick to Brick podcast. And this is something really special for you guys. This is behind the brick, but it's behind the brick in the vault. And for this episode, we're doing something for the very first time. We're doing Q&A. These are the questions that you guys put on the comments. These are the questions that you guys called us. These are the questions that you text us. We're going to answer them for you guys on Behind the Bricks in the Vault. Your boy, Bryan Karp, a.k.a. Mailbox Money, Anthony Loffredo, the underwriter, the brain, the mathematician, a.k.a. what else can I give him? A.k.a. the professor. How are you?
I'm good. How are you?
Fantastic. So we're going to dive right into it. Question number one that we received was, Anthony, what is your role in Future Gen REI?
My role is to underwrite all of the potential deals, to do all the financial reporting, track the numbers, come up with participating strategies and in how we do the value add, how we eliminate some of the expenses. And I try to, also raise capital, meet people, all that kind of stuff.
I'm going to ask myself the question, Bryan, what's your role in the syndication? Before I do that, let me tell you something. It's when you're putting together a partnership, you have to have a partner that has in my opinion, the exact opposite qualities of you.
Without a doubt.
Because if I can't, not that I can't, I can't, let's be honest here. I can't do the numbers. I can't do the numbers at a level that Anthony can do them. So to me, if you're going to have a partner, you want them to complement everything that you don't do.
Correct.
So what's my role? My role is to help build broker relationships. My role is to help build limited partner relationships. My role is to help raise money. My role is to be a sounding board to Anthony, to run by ideas. Those are my roles. My roles are to stay in contact with our brokers, to stay in contact with our limited partners, to have some big ideas for the vision of our branding, future
marketing,
our marketing. Yeah, to get the attention, just like I got you guys watching, right? It means I won the game. The key to any business is getting the attention. So that's my roles. And I really think Anthony and myself partnership works so well together. Not that either one of us can't do the other person's role, but to me, those are my strong points. Is speaking to you guys. My strong points is talking up a deal. Anthony's strong points is looking over the numbers and evaluating the deal. So I think it's a perfect partnership.
Correct. I agree.
All right. Question number two. People should know this, but I think it's an interesting. We use the word syndication or single asset syndication. Anthony, what is that exactly? Can you break that down?
Yeah, I'm just going to go I'm going to answer the questions based on our particular fund.
Yep.
So the syndication really is just it's a partnership between us, the general partners, and the limited partners, pooling together their capital to assist with us in the purchase of an asset.
Okay. And then the next question with that, which I will kind of help do, and Anthony will jump in. What's the difference between a syndication and just an LLC? Why are you guys not just buying real estate with an LLC? So the answer, first off, is the assets are not in Anthony and Bryan's names. They're in an LLC, but the owners of the LLC are the general partners, ourselves, the sponsors, and then a group of limited partners. Now, Anthony, why would somebody want to do a syndication model opposed to just getting an LLC and bringing a bunch of friends and investors in?
Well, there's just certain ways that to structure to protect each individual with their investments. So the way that we have it set up, you have your corporate attorneys come up with this kind of stuff. So, we're not in the weeds of how the exact formations and structures are, but we kind of give the overview of what it is that we want to do. And then we take the assistance and the guidance of our corporate attorneys and our accountants. So they're really the ones that put together the flow chart of how the LLCs operate, and how we put together the entire structure.
Perfect.
You know,
I think you broke it down simply.
yeah, it's
I never
you want to lean on the people that are experts in their field, right? So the corporate attorneys are experts in the structure and all that, and then the accountants, are experts in the tax implications and the smartest ways to kind of set up the entire structure. So you got to lean on the right people.
And such as, we have a whole team. We have a securities attorney that writes the PPM, which is the private placement memorandum. And what goes in there is it talks all about the deal and what the deal looks like. And correct me if I'm wrong, these are just non-public assets, right? Or what is it, like non-public? These are people are buying shares in our assets.
Yeah, exactly. So it's an LLC with shares, and each limited partner gets X amount of shares depending on their investment.
Next question is, why Tennessee?
Tennessee was one of the target markets that we chose because it has very good landlord laws. There's tons of job growth, and there's, positive migration. So there's a lot of people that are moving into the state for multiple reasons.
100 people a day.
100 a day into Nashville alone. So.
And then what ends up happening is people decide they don't want to stay in Nashville, and they start spreading themselves out to secondary and tertiary markets from there.
Yeah, and it's a state where you could scale a lot easier than, say, a Northeast state.
It's the two complexes that we currently own and manage under Future Gen REI, those are ones, they're both sub 50 units. To find 50 units in New York would be next to impossible.
Yeah, it's just a completely different market and a price point, and you can't compare investing in multifamily in New York to Tennessee. It's just a different game.
I think another reason why Tennessee was the landlord laws that Anthony said. I also think the weather. I think if people have a choice, they'd much rather a warmer climate to a northeastern climate.
Yeah.
So I think that's important. I also think that it's important that Tennessee doesn't have any state income tax. So
that's attractive for people to move in.
Right. So when you look at people when
they're not on the coast, so you don't have insurance issues that you have to deal with.
Yeah, it's in the middle. So for us, it was kind of a perfect storm. And we thought when we first started this, 2 years ago or 18 months ago, we thought that, all right, maybe we'll buy an asset in Tennessee and then one in Carolina and then one in Kentucky and one in Georgia. But then when you start to get boots on the ground, you realize you really have to go deep on a state. And when you go deep on a state, we could probably spend our entire careers just buying in Tennessee.
Yeah, you can. What you need is you want to build as many relationships as possible. So casting a net that goes to 5 different cities is just, for us, it wasn't a strategy that made sense to us after we went down to Tennessee. After we went down to Nashville that first time. So, honing in and building relationships deeper, like you said, is important.
I think also understanding the market.
Yeah.
And understanding the towns and the sub
all the areas, yeah.
I'm not that smart. So for me, if Anthony was like, all right, Bryan, we're going to move to a different area, I don't know if I could do it because I'm finally getting a grasp of, all right, here's Jackson, and this is where Chattanooga is, and this is where Bowling Green is, and this is where Knoxville and Northern Tennessee, Western Tennessee. Like I'm starting to see it, and it just makes it easier, in my opinion, for us to invest.
Yeah, without a doubt.
All right, next question is, how many partners are in a syndication?
Really, you could have as many as you want. Typically, we have 2 general partners, me and you. But when it comes to limited partners, it just comes to the amount of money that you need to raise. So if you're raising $1 million, you could have 10 at 100,000, you could have 1 at $1 million, or, you could have 100 at 10,000. It just depends on your fund.
Who sets the terms for the fund?
The general partners. Yeah, you go over everything with your corporate attorneys. You kind of give them the big overview of what it is that you're looking to do. And then you kind of narrow down all the specific language that has to go into the docs and the subscription agreements and all that good stuff. And you want to also meet with your accountants too.
And this is obviously, this is not financial advice. This is just two guys on YouTube or a podcast telling you a little bit about it. But basically what it is as the general partners, we decide how the money gets distributed. So there's different tranches, and the way you set it up is you have a portion of the profit going to your limited partners, and then you have a portion of the profit going to the general partners.
Right. So like anything else, you don't want to reinvent the wheel here, right? So you want to kind of copy and paste what the people that are successful doing the same thing that you want to do. So that's why we structured it the way we did. And to Bryan's point, yes, we increased it a little bit for our limited partners, right? Because we didn't have the track record and the reputation that the really big guys do, right? So they're able to kind of chop out a lot more fees and things like that for themselves and split the profit a little bit more in favor for the general partners. But we did not do that. We tried to keep it really light on our end for fees, and just so that the limited partners get a bigger piece of the pie. Mm-hmm.
Somebody asked us, how do I get paid back?
So depending on the particular asset, most of what we do, because it's value add, in the first 12 to 18 months, we're really just trying to implement our value add strategy, get the asset stabilized, and then basically, based on the performance of the asset and the cash flow, and what we will do after that 18-month, 24-month period is quarterly distributions. So you kind of, as the cash flow comes in, you distribute on a quarterly basis, a portion of their investment back to them. The big payday comes on the exit.
On the exit.
Yeah.
So and somebody asked the other question that went with this, somebody asked, but you guys are almost like long-term fix and flip investors. Somebody said to me.
Yeah, that's a good way to put it, right? So the first 12 to 18 months, 24 months, depending on how deep you want to go with the asset, that's exactly what you're doing. It's just a long, slow fix and flip process.
What is the difference between us as a almost fix and flip investment for 4 to 5 to 6 years? What's the difference between us and then the people who are just buying and then just collecting cash flow?
Yeah, it's a different type of buyer. So when you want to buy a fully stabilized cash flowing asset, it's just a different business model, right? So typically there's ones that will buy properties straight from the developer so that they have somewhere to park their money and cash flow a little bit. And then there's the value add, which is what we are. And then there's like the super distress, which, the buildings that are 20% occupied or just not occupied at all, that go in there and have major, major renovations and stuff. So we're kind of right in the middle. We like to add a little value, in that first 1 to 2 years, and then cash flow, and then exit out when we feel it's appropriate.
And we got a deal in a really cool market that was a 20 unit and a number that looked ridiculous. And then when I started to look at the deal, it was bank owned and it was 100% vacant. So on an asset like that, you couldn't even get financing from Fannie and Freddie. You'd have to buy it cash, then you'd have to have the money to renovate, then you'd have to stabilize the property and then go to get your financing on it.
Yeah, different business model for sure. So it didn't fit what it is that we put in place for what our goals are.
And it's a much riskier business model.
Yeah, higher risk, higher return. Same thing with the already stabilized cash flow, and lower risk, lower return, and we're kind of right in the middle.
Somebody wanted to know, what are the risks of investing in real estate, but what are the risks of investing in a syndication?
Like any risk, there's chances that things could just completely go haywire. We like this asset class because we already have cash flowing tenants and stuff. So we really do a lot of different things to kind of mitigate that risk. So, location, asset, that kind of thing.
I also think, listen, there's risk to any investments, but I think we've mitigated a lot of the risks. That's from our due diligence that we do. But I also feel like just the asset class itself, right? So it's not a single asset tenant, right? I had a guy call me on my resi business, but we referred him to on the commercial side, and he's renting to a very large publicly traded company, and now they're leaving. And they were paying $34,000 a month to rent it, and now the place is going to be 100% vacant by the end of the year.
Yeah.
So to me, the commercial or single tenant asset space is very risky. Opposed to us, we buy value add multifamily in our property in Dixon. Right now we have 44 tenants. So yeah, one or two people leave, it's no big deal.
Right.
So to me, that's number one, how you mitigate your risk. I think number two is you're buying a physical product. Like you're buying bricks and stone and glass and electrical. So it has a tangible value to that.
Mm-hmm. Yeah. Yeah, that's a major thing, and that's always been our that's always been our mindset, right? For everything that we do from where we started. So there's the components, right? There's also insurance. We over-insure just in case any natural disasters or fires or error or anything like that. So, we really have thought out and put pen to paper on the mitigating risks of investor capital and alone.
Absolutely. And I also think that we're buying something that is producing income.
Yeah.
If you look at all of our assets from day one, every single one of them is cash flow.
Yeah. And it's becoming more and more of a renter nation, as time goes on. It's, you look at the affordability of somebody trying to buy a house right now, they're almost forced to rent at this point. So
I heard a stat what was the stat? It was so mind blowing. It said that real estate and the world has almost gotten 80%. Well, yeah. So, okay. The world has become 80% more expensive than it was 2 years ago, but salaries have only gone up 20%. So really, when you think about that, right, your rent was $80, now it's $160, right? It's almost doubled. So we're moving more towards a nation that is renting.
Yeah.
And it's more affordable to rent.
Yes.
So owning these assets, to me, are great.
No, yeah, without a doubt.
The next question with this one was, well, what if things go wrong? And, I'm going to jump in. I'll let Anthony do it next. If it goes wrong, it's not that it goes wrong. The only risk from what I see is it just takes longer. And they said, what if the market turns? The market could absolutely turn. Real estate doesn't just always go up. But the nice thing about these assets is we get long-term fixed debt. On our first asset, our 51 unit, we have a 10-year fixed rate mortgage at 5.49. So if the market turns and there's a recession and there's an issue in the economy, we don't exit. We hold the asset longer and the asset will appreciate, and money is getting devalued every day we sit here. So that only will increase the value of the asset.
Yeah. Locking in, you can really put yourselves in a hole if you don't lock in the correct financing. So that's really a huge, huge component. You want the asset cash flowing from day one. You want the right finance in place, and you want the right location, So those are the three biggest things that you want to make sure you have a good plan in place, a thought out plan, a research plan in place for all those three components.
Next question, who manages the day-to-day?
The property managers. Super important. You want to interview multiple property managers in and around the area, and make sure that they're the right people that you want to. Essentially, you're almost partnering with them, right? They're taking a piece of your rental income, so they're like a partner. You want to make sure that you have the right people in place to manage that aspect.
They're a partner that put up no money. So it's a great role to be, but they really create a lot of the value and do a lot of the heavy lifting. A lot of Anthony and myself's day to day is managing our PMs.
Yeah. Yeah. Making sure you're constantly in contact with them. You don't want them to get lazy. You want to make sure that you're not an absentee owner. So you want to hold them accountable for what they say they're going to do. And, you want proof that they're doing that, what they say they're doing as well.
Someone said to me, Bryan, how do you pick a PM? You're going to know when you meet with them. It's a lot of times, and I'll give you an example on the Dixon market. We were going to potentially use our PM that was in a different market, but then Anthony and myself thought it would be the best thing for the fund to have a super local PM. So what did I do is I went online and I started pulling up all the PMs that were local to our property. And then I started setting up interviews. You could just tell by the cadence of how quickly someone responds to you, how quickly they jump for the ask that you have. And it wasn't even like we went with the cheapest PM. You could just, I don't know, I'm in a sales business and I'm in a client service business. I could just tell that someone who reacts the way I react, jumps on the Zoom on time, has the information we want, seems like they're knowledgeable, has the right systems, has the right processes. Like, you're going to know when you speak to the right one. And I feel like it's very important to either meet them in person or get on a Zoom call with them.
Yeah, I would meet them in person. I would go down there. I would look at other assets that they manage, so you get a good idea on what they're, the proofs in the pudding, right? So if you say, take me to one of your buildings that are close by that you manage, and they don't want to do that, well, there's a reason why, right? So that's important. This is not something you want to rush into or take shortcuts on getting a project manager.
What is our biggest win so far?
Our biggest win, I think, just getting these to the finish line, getting started, getting that first asset. I think that's always the biggest win, right? Getting started, getting the funding in place, getting it across the finish line. There's so much to learn in that first deal that you can then take all of that and apply it to the second one, right? So it took us a year to get the first one, and it only took us a couple months after that to get the second one. So it's, and now we're actively looking for another, and it starts to snowball. You start to learn a lot. You start to legitimize yourself with all the other brokers, right? So now we have brokers reaching out to us because they know that we can close. So, just the biggest win is certainly just going from 0 to 1.
I couldn't agree with you more. I also think the biggest win is proof of concept. Like, this was just an idea that we put together.
Yeah.
Obviously, we didn't create the idea of buying multifamily real estate under a syndication and raising money in Tennessee, but it was an idea, and we had to go there, learn the market, meet the brokers, build relationships, and then find an asset, and then close the asset, raise the money, get the financing. Like, to me, just doing it is the win. Like, we won with that, and now it's just going to take time, effort, love, and attention to get them to where we need them to be.
Yeah, it's like anything else in life. You say you're going to do it, you got to do it.
All right, then, to go off of that question, what is the biggest thing you didn't know before you were doing this?
The importance of the property managers. I mean, we knew it, right? You read as much, you read it in books, you hear it in podcasts. It's, it is what it is. When you get down there and you start to realize how much the property manager, how important the property manager is, especially when you're out of state, I would say that was definitely the biggest thing.
Yeah, so the biggest thing I didn't know is, I definitely agree that the property manager, I definitely didn't know. I guess I was just worried, like, who puts the utilities in their name, and where do the rent checks go, and who holds security deposits. Like, I was worried about being a landlord myself of almost 50 units. I was worried about all the nonsense that I worry about.
Yeah.
But then I realized, really, if you find a good property manager, they're going to deal with
Their job, yeah.
Yeah.
That's what you're paying them for.
Mm-hmm. So I think that's the thing I didn't worry about, and I was apprehensive with it. I can't lie to you guys. On the first one, I was scared, and I was like, Anthony, who's going to put the electrical meters? Like, who's going to make sure the landscaper is there? And you kind of jump in, and you're like this, and you're nervous, and you're like this, and then, it all comes together. Like, the rent checks all go where they need to be. When there's a maintenance issue, the tenants all find out who the PM is.
Yeah, they're huge. Mm-hmm. Yeah, you can't underestimate them.
The next question is, what has been the biggest, what did you think was going to be the biggest challenge when you first started this?
I would say raising the capital.
Okay.
And
I think we did a pretty good job, right?
Yeah.
We raised, almost over $3 million?
Yeah, yeah.
Over $3 million, and we actually raised even more, but we ended up deciding not to close on another asset.
So we have some on the sidelines that are waiting.
So I agree that if you would have asked me 2 years ago what was the hardest thing, I was going to say raising capital, but I kind of just knew that if you find a good deal, the money's going to come, because I always believe in that. If it's a really good deal, I think the thing that I didn't think was going to happen is I didn't think we were going to be able to make like new relationships with people. And I didn't think we were really going to be able to like comprehend or understand a market. I don't know if I believed it. Like I believed that we could do it and we could do anything. I don't know if I believed like it was going to come to fruition.
Right.
Like, all right, yeah, sure, makes sense. We're going to find multifamily that pencils, but like there's, so you kind of just got to do it and jump and go.
Yeah, there's a lot of moving parts for sure. I was going to mention something else, but it's all right. Go ahead.
I think that goes with what's been the hardest thing. I think the hardest thing, honestly, with all of this is finding a good deal. I think that's the hardest thing to finding the deal.
Yeah, finding a good deal is certainly the hardest. There's so many of them that come across your plate that, you could make them work with the numbers if you wanted to, but that's obviously not something that you ever want to do, right? You don't want to make the numbers work to make it work to get the deal. You don't want to do that. You always want to stick to your models, stick to the financial models, and when one of them comes across that works, then that's good. Then you move forward with it.
Podcast break. This podcast is sponsored by Future Gen REI. Future Gen REI is a single asset syndication. Basically what happens is Anthony and myself help you guys, our friends, our family, the inner circle, become inside players in real estate. We help you guys invest in the greatest asset in the United States of America, which is multifamily real estate. And we put your money with our money, and we all partner together to buy amazing multifamily real estate. All right, back to the podcast. You had something you were jumping in on, or I can go back to the question?
No, you can go back to the question.
Okay, back to the questions that we have. Everyone says you guys are now rebranding with Future Gen. Explain Future Gen. How did that come about, and what does it mean exactly?
Well, I think what we wanted to do is make the name relatable to what our goals are, right? And so we both have the idea that this is going to produce and feed generations of our family and our limited partners' families for years to come. So that's kind of where the idea came from.
Yeah, no, I love it. It's so I'm doing this for generational wealth.
Right.
We're trying to build something now that our kids will receive a benefit from, but even our grandkids can. So that's why, when we were going back and forth with ideas and we brought a whole company in to help us with the brand and the color and the feel, it was like, all right, we're all about future. Because to me, it's like most people live for today, right? It's like, what feels good today, right? Sleeping in feels good today. Spending that money on something flashy feels good today. But really, if you look at what I built and what Anthony built, it's all about delayed gratification and it's all about the future. So we wanted to build something that you could invest in today that will help you in the future. And so it says future, and then Gen is short for generations, because I said to you, we're trying to build generational wealth. And if you look at 90% of the first millionaires are all made through real estate.
Yeah.
So we felt like putting those two together kind of gives us, like, I feel like the name embodies what we're trying to do. We're trying to help our friends, family, inner circle build generational wealth for the future, not for today. And then if you look at the symbol on Anthony's hat, and then you guys can throw it up on the podcast in the background, the symbol we had is kind of a thumbprint. And each thumbprint is different. And every person is different. And every one of our investors are different. And every one of our assets are different. But we all come together with the same purpose. And then we put on the colors are just, they have good vibes. They're like it's like a good energy, good vibe color palette. And what you'll notice is on all of our assets that we manage today and all of the assets in the future, we use the same color palette for the rebranding. We use the same letters for the rebranding. So there's a lot of thought behind everything we're doing with Future Gen REI. So talk to everybody about the portal that we're going to be putting together for our LPs and our new investors.
Yep. So along with the new name, the rebranding, We have a new website that we'll be launching, and then within that website there will be an investor login to their own portal, and it'll have all of their investments, the properties that they're in, all of the updates on the properties, all of their important documents that are in there. There'll be important emails and updates going into their portal, and they'll get alerts for that. So it's just like a nice, clean place, all the tax stuff. So it's going to be a nice, clean login and just an area for all their subscription docs. All that stuff is all going to be inside of their portal.
One place.
So that they'll know where their distributions are. They'll just have a really nice, fun layout of their investments.
Awesome. And it's going to be really cool because for our previous projects, we had to send a subscription out to you, John, send a subscription out to you, Steve, you, Sally. Now they're literally going to have a portal they log into. They can sign all the financial documents. They can get all of their tax stuff, right? When we send out your
K1s, yeah.
When we send out your K1s, it's right in there. And then you, at any time, 24/7, you can log in and see what the asset's doing. And they're still going to get their either monthly or quarterly updates from me and Anthony of what's going on. So I'm so excited for the big rollout, which should come sometime late August and early September. Okay, let's see if there was any other questions that I wanted to hit. Anything else, Ant, that you wanted to put in there?
No, you had a good amount of questions.
Okay. I think one of the last questions here is why would somebody invest in our syndication? And I think the reason is if you're going to go do this alone, it is a very, very difficult and long road. And I know that we're still relatively young in this business, but I've been buying rental real estate, buy and hold real estate, and multifamily real estate for almost 2 decades. Anthony's almost the same. So the knowledge that we've learned is incredible. And a lot of it you can't read, you can't watch on TV, you can't get from a podcast or a book. So we're able to help you guys manage your wealth and invest with us. Like everybody wants to invest with an inside player. Well, we're the inside players and you get to park your money next to our money. And the cool thing is all together, we're able to buy bigger and more incredible assets. So without our incredible limited partners, we wouldn't be able to buy these assets that are this size. We wouldn't be able to scale this big. So it's kind of like everyone's coming together with one purpose, to build generational wealth and to partner together to really do something special. So I think it's just an incredible opportunity. Listen, we're not the only syndication out there, but I think we really bring a special edge and a special flair to the whole situation. And I think you should take some time to set up a one-on-one with us, learn a little bit more about what we've been buying and a little bit more about Anthony and myself. And we look forward to speaking to you.
Thank you.
See you next time.